using in their evaluation. And it starts with the CFP board materials, the roadmap for the new practice standards. And that roadmap defines what financial advice is. And financial advice now is different than it was prior to the new practice standards. Prior to the new practice standards, the financial planning was only subject to a fiduciary standard of care. Now, any communication that can be reasonably viewed as a product recommendation that the client can take or refrain from taking is now regarding purchasing or exchanging, I added holding, gifting, or selling financial is financial advice. And when providing financial advice, CFP professionals have a duty to the client to act as a fiduciary and act therefore in their best interests. And best interest is not a subjective term, either in fiduciary circles or fiduciary law or CFP practice standards. It is defined to have particular meaning. And we're going to talk about one of those meanings. I'm not going to talk about all of them today, but I'm going to talk about one of them that is particularly applicable to life insurance, and that's the duty of care. And the duty of care that a CFP professional must embrace is exercising reasonable care, skill, prudence, and diligence when providing financial advice. And when it comes to insurance, when it comes to anything, that includes, in any product recommendation, it includes the costs that the client may incur. And for life insurance, right from the roadmap, the source of that information is insurance illustrations, but not always. So we're going to dive rather deeply into that source of decision support information. So these insurance illustrations that I'm sure you all have seen many, maybe too many times, are regulated by something called the National Association of Insurance Commissioners Illustrations Model Regulation. I guess actually they're regulated by each state's adoption of the NAIC Illustrations Model Regulation, which all have adopted except one, which we're going to talk about. So under this NAIC Illustrations Model Regulation, what is an illustration? An illustration is legally defined as a depiction of non-guaranteed elements of a life insurance policy over a period of years that's comprised of some 50, sometimes less, sometimes more pages, thousands of numbers, dozens of disclaimers, and the client is supposed to sign many of them, if not most of them nowadays, attesting to the fact that they understand all the pages, all the numbers, and all the footnotes. All these numbers and pages and footnotes are based on the cost of, so they're a depiction of non-guaranteed value. So non-guaranteed premium, non-guaranteed cash value, non-guaranteed death benefit, but all of those are based on cost of insurance charges, which comprise 85% of total costs. So if you're looking for opportunities to help clients lower their costs, get new clients by helping them lower their costs, exercise reasonable care, skill, diligence, and prudence in examining costs. Cost of insurance charges is the first place to start because it's by far and away the biggest. Insurance companies also charge policy expenses for the design of the product, marketing, sales, distribution, underwriting, administration. And then these non-guaranteed elements are based on these cost of insurance charges and the expenses that have to be covered by premiums less whatever the policy earns. So if it's a term insurance policy, there's no cash value that would be credited with anything or that would earn anything. So that's pure cost of insurance and expenses. But if it's got cash value, if there's any amount paid above and beyond the cost of insurance charge and expenses, then that goes into the policy account, and that gets credited with interest or earnings. And so what you absolutely positively have to understand as a fiduciary, or if you're serving a fiduciary, is not the premium that's quoted, not the cash value that's projected, not the non-guaranteed death benefit, but you've got to understand what my dad used to call the givens. What are the things that determine that non-guaranteed premium, that projected cash value, and that death benefit? And it's the COIs, the expenses, and the interest. That is ultimately what will determine what the client has to pay. What the insurance company assumes at the point of sale in their illustrations is where many of the problems arise. And this formula here would be for a defined death benefit type scenario where a client says, I need $1 million or whatever. What's the premium? Well, this is the way you would vet. You would exercise reasonable care, skill, prudence, and diligence in determining whether or not the premium is a reasonable premium for the client to expect if it's not guaranteed. If it's on the other side, if it's a wealth accumulation style type plan or objective, then I'm going to jump ahead a little bit here because this is a little redundant. Then the growth of the account would be whatever the earnings are. So whatever the account is growing to, minus the expenses, just like in any other asset. What's my growth minus my expenses, and that's what my account's going to be worth. Where the problems arise in these illustrations, and where the NAIC illustrations model regulation doesn't do a good job. And that's not my opinion. I'll show you why. I'll show you how it doesn't do a good job, and you'll come to the same conclusion. Is that when we're looking for a policy that either has a low premium or high growth, we would be looking for a policy that has low costs, that has a good earnings potential relative to clients' risk tolerance, and then that would result, just like any other asset. When you have low costs and good performance, that's going to be an account that outperforms other accounts. Conversely, at the risk of stating the obvious, if you had an asset that had high costs and poor performance, then that's going to have poor growth of the account. Where this illustration model regulation falls down is it permits insurance companies to quote high costs, or to project growth based on high costs and high interest rates, high earnings rates, without any disclosure of the high costs or the risks of underperformance due to aggressive performance assumptions. So I want to delve a little bit more into that, but before I dive deeper, I don't want to leave you with the impression that these illustrations are not useful for a number of things, and they are useful for a number of things. They certainly are good for modeling, how the policy works. What if I pay 10 years? What if I pay 20 years? Different funding strategies. It's certainly good for modeling. What if I get better performance? What if I get worse performance? What if I drop the death benefit? So they're very good for what if analysis. They're very good for planning. You couldn't do a cash flow projection for a client that involves insurance unless you had an illustration that showed what the premium requirements were, or what the distributions from the policy might be. So they're very useful for all these things, very legitimate uses. But unfortunately, they are also used, in fact, they're probably used more often than not for some other things. They're used to try to find out which policy has the most competitive cost by comparing premiums. So, with the presumption that premiums are some proxy for costs, and we'll come back to that. They're not very good. In fact, they're not useful at all for trying to understand the reasonableness of performance requirements, and we'll go into an example of why that is. And they're not good for assessing whether or not the risk inherent in the product is consistent with the client's risk tolerance. And again, I'll go into an example. So these are all questionable practices, which we'll dive into right here. So this is an actual illustration. The excerpt of the actual illustration is in the Michael Kitces article, so I know this is hard to see on the screen. I've kind of blown it up with a magnifying glass so you can see the parts that are most relevant, but you can see the actual illustration. I've taken the company names off because this is a prevailing practice. I don't want to single out any particular company, but you'll see the actual snapshot from the actual illustration. And the illustration says that non-guaranteed values. So remember, this is a depiction of non-guaranteed elements. So non-guaranteed values at the end of the year are calculated at 5%. So any reasonable person that I know would assume that, so my account values are assuming that whatever I pay or whatever the client pays above and beyond cost of insurance charges and expenses, those are going to be credited at 5%. But if we dive a little bit deeper down, and a 5% rate of return, I know I'm saying something that everybody on this call knows, but a 5% rate of return would be consistent with a client that has a more conservative risk profile. But if we dive a little bit deeper down into this illustration, into pages that I refer to as the policy accounting pages or the detailed expense pages, every insurance company has their own name for them, but basically they're the year by year disclosure of expenses and performance requirements. And as I will also say later, if you don't have these, there is absolutely positively no way for you to know whether costs are justified and whether performance is reasonable and whether risk is appropriate. And this is where I say the NAIC illustrations model regulations just fall short of CFP practice standards. And as a result, if you're a CFP, you're going to be held to CFP practice standards. And this is where you can get into harm's way, because this actual illustration shows that the account value at the end of the year is $117,000. And then it also shows that on my $117,000, I have to be credited with $16,000 or almost $17,000 of interest or earnings. Well, I can pretty much do that one in my head. That's not 5%, but on the first page of the illustration, not the fine print 35 pages in, but on the first page of the illustration, it told me that I was all I needed to earn was 5%, not something more than 5%. Well, $16,000 on an ending account balance, $16,000 of interest. And I know you can't see in the magnifying glass, there are no premiums being paid here. So there's nothing else going on here other than the interest being credited to the account. And you can see that if you're following along in the Michael Kitces article, you can see what I mean. There's no premiums, there's just expenses, and then you're supposed to earn you have to earn, or the client has to earn $16,000 on a $116,000 or $117,000 balance. That's a 14% rate of return. That's not a 5% rate of return. This is where, if you don't get these detailed expense pages at a minimum, if you don't get these policy accounting pages, you can get into harm's way as a CFP under new CFP practice standards. The NAIC, they're struggling with this. This is, they've been trying to regulate this since 1995. The goal of the regulations are well-intended. 1995 it was somewhat soon after the introduction of universal life. So the regs were well-intended. They were designed to help advisors and clients understand the differences between whole life and universal life, because they are just vastly different products. Costs were not even available on whole life back then. And so it was an effort to level the playing field between universal life and whole life, so that the NAIC was trying to get carriers to calculate the premiums similarly, so that premiums could be a proxy for costs. But as late as 2015, the NAIC concluded that, by their own admission, that, some carriers are saying that they're calculating at 5%, and or they're actually calculating account values at 5% or calculating premiums at 5%. But other carriers, as you just saw, are calculating premiums and cash values at 14%. And so the NAIC even concluded that there's a lack of uniform practice under their regulations. So they've been trying to modify it and update it. Some of you with maybe a little more insurance exposure may have heard of AG 49. So continuing on, and I'll try to pick up the pace a little bit here. So as I just said in response to that question about insurance products in general, annuities and life insurance, the NAIC definition, or what they consider to be the information that's needed to make clients' best interest determinations, lacks uniform practice. We've also, the rules themselves require no disclosure of costs, performance, or risks. You have to ask for those pages, as I alluded to earlier. I said before, the NAIC regs just are insufficient for practice standards. That's not my opinion. FINRA published a rule saying that it's inappropriate to compare a life insurance policy with another one based on those non-guaranteed factors, unless you are including just comparison of costs and expenses and comparison of investment objectives. Comparing the non-guaranteed numbers without looking at cost, performance, and risk, they consider misleading. The Society of Actuaries commissioned a study years ago, which I don't think anybody disagrees with it, but they're just the NAIC has just got this focus on trying to regulate the outcome rather than the process. And the chief actuarial body of the life insurance industry says that comparing these illustrations is not just inappropriate, it's fundamentally inappropriate. And the chief regulatory body for fiduciaries, the OCC, which oversees national banks, so all the big banks, and all of those big banks have fiduciary businesses. They caution their fiduciaries that these illustrations are subject to a high degree of fluctuation, and certainly anything that's subject to a high degree of fluctuation is not reliable as decision support for product recommendations. So Michael Kitch, as I told you, wrote a couple of articles, took a white paper I wrote about the New York Best Interest Rule, turned it into a couple of articles. Again, those are available for download. The bottom line, if you're a businessman, or the punchline, if you're a comedian like John, is on page 5 and page 6 of the if you downloaded it and you're following along. But while the NAIC illustration model regulation was intended to allow these illustrations, allow premium comparisons to be a proxy for costs. In other words, the product that has the lowest premium, the intent of the NAIC regs is that the product with the lowest premium would have the lowest costs. So it can be a proxy for finding the product with the lowest costs. 5% rate of return being used, but we know what that's worth based on our magnifying glass examination earlier. But any reasonable person would say, oh, well, the universal life policy must have a lower premium. excuse me, it must have lower costs because everything else is equal, because I've asked for everything else to be equal. But if you actually look at those detailed accounting pages or those year-by-year cost disclosures, you find, which are in the Kitchens article, you find that the universal life policy has costs that are much higher. Again, because under NAIC regs, insurance companies are allowed to game, if you will, the interest assumptions and then include disclosures in the fine print of their footnotes. So as an alternative, I think the New York best interest rule, it's not perfect. I call it a fiduciary-like or fiduciary light rule, but it's much better guidance for CFP professionals who are who now are required to exercise reasonable care, skill, diligence, and prudence in financial advice or product recommendations. So looking at what the New York best interest rule says, and I'm going to go fast here to try to catch up on some time, because this is anybody with a fiduciary orientation or background, or who is a fiduciary, who works in an RIA or in a financial institution. You're familiar with this. This basically brings the life insurance business up to where all of the rest of us already are. You got to consider the interest of the consumer first. You just start with the customer first. Don't start with the product first. You've got to use reasonable care, skill, prudence, diligence that a prudent person would make in selecting a product. And if there are any limitations on your ability to distribute a product, which there are lots of those nowadays, less so in the investment. But when I first came in the investment business, there were lots of limitations on, which mutual funds you could have access to. There are still some, but in the life insurance business, there's lots of limitations on what you can help a client with. And so simply disclosing those, I call it an exceptions list. Having an exceptions list in your deliverables to the client, that they may have to go talk to somebody else if they want to, but this is the best, lowest costs, best performance and reasonable risk from the universe that you have access to. It's got to include all products and services of the ones that you have access to. You got to match up product recommendations with the what is suitable to the client. Again, are risks appropriate to the client's risk tolerance? And at the end of the day, is the product being recommended, or is the product being placed? Does it have justifiable costs? Does it have reasonable performance requirements? And is risk appropriate to the client's risk tolerance? So we've looked at how the NAIC falls short of a fiduciary standard or the CFP best practice standards. We've looked at an example of regulations that speak to a fiduciary-like approach to life insurance. So let's put this into a CFP practice standards context. One of my companies serves as sub-advisor in the same way that investment trusts delegate the review of assets to investment advisors or portfolio managers. A growing number of life insurance or growing number of trust companies that serve as life insurance trustee have engaged my firm to review the policy assets in their life insurance trusts. And the first thing I tell them, for the reasons that we've already talked about, if you've got comparisons of hypothetical illustrations in your trust file or in your client file as your documentation of your diligence in the product recommendation or your decision support for accepting that product or recommending them, get them out of your file. At a minimum, insist on those detailed accounting pages or policy accounting pages or detailed expense pages. Again, download that Kitchens article. You'll see what they look like. So because you got to ask for them. I am sometimes aghast that when you ask for them, even the people who work for the insurance company don't know what they are. So you got to explain what they are. So you'll see what they are in the Kitchens article. At a minimum, as a CFP, compare those costs and compare the performance requirements separately. Don't compare premiums, don't compare cash values, don't compare non-guaranteed death benefit coverage duration. Compare the costs and the performance, and make sure the performance is the risk of underperformance, which I'll come back to in just a minute, is consistent with the client's risk tolerance. And so how do we know whether costs are justified and performance is reasonable and the risks are appropriate? Well, if it was any other asset on the client's balance sheet, we would benchmark it. If it was a client that had a moderate risk tolerance, and we were looking for a mutual fund, the S&P 500 might be a good benchmark. And so we'd look at, does the fund net of fees correlate above or below? I came from the investment business first. I used Morningstar. And when I went from my first job, which was as a analyst in a pension investment advisory business where I used Morningstar, when I went from there to go work for a life insurance agency, where they told me that, the way you figure out what product is right for the client is you insurance business for a while. So I was like, okay, let's see how that works out. Well, it hasn't worked out. Forbes wrote a great article, Wall Street Journal wrote a great article about universal life and how, it was the rage of the 80s, and it has just woefully disappointed because these quotes just never come true. You've got to examine cost, performance, and risk. And there are some other things that are important to consider in life insurance beyond mutual funds. Certainly the financial strength and claims paying ability of the company. I've already mentioned costs. Getting out of a life insurance policy is harder to do than getting out of a mutual fund. So we want to make sure that there's not a bait and switch going on. So are the illustrated expectations reasonable? Are they reasonable to expect? Again, we can't get out of life insurance the way we can get out of a mutual fund. So how much liquidity do I have? What is my, if it was a hedge fund, my lockup period? What are my restrictions on my liquidity? And the one that I am surprised almost never gets asked is even, expensive attorneys, sophisticated CPAs, ultra high net worth clients, they get these illustrations and they say that the performance is at X%. I can't remember the last time anybody asked, well, what have they actually done in the past? But they always ask that for any other asset that's on or any other recommendation, any mutual fund or any hedge fund. What's the track record? They never ask it about life insurance, but certainly that's something that would be benchmarking performance, actual performance would be meaningful. So I'm going to drill down into two ways. This is what John was talking about earlier that he has found so useful in his practice. I'm going to drill down into how Veralytic benchmarks the cost. I'm not saying this is the only way you can do it, but this is the way that we do it and that you could do it and the way John does it. So we look at the costs of the policy under evaluation, present value cost per dollar of insurance for the policy, either in force or being considered. And then we benchmark that or compare that to the average cost of insurance charge, expense, and premium load for everything in our database. And the average is in the middle, right? So that's the average for institutional policies is the bar in the middle. And then very rarely, but for the sense of completeness, we include smaller policies. So the middle bar is where most people who pay for advice, most people who pay CFPs a fee, you're going to be dealing with the middle bar. But occasionally they'll have a small policy and you'll be using the bar on the far right. As I said, the benchmarks are the average, so that's the middle. And around that middle in life insurance, there's an 80% variance between good and bad pricing. Adam Smith would say that the ingredients to an efficient market are the free flow of information. We've already talked about how opaque life insurance is, life insurance product is, life insurance pricing is. And most people don't know what they're being charged. And if you don't know what you're being charged, you can't choose good pricing from bad. And if you can't choose good pricing from bad, it gives carriers, insurance companies, a lot of leeway in what they charge. And so there is as much as an 80% swing between good and bad pricing, which means that the worst available rates and terms in the marketplace are going to be 40% higher than the benchmark, and the best available rates and terms in the marketplace are going to be 40% lower than the benchmark. And so this is a graph that comes from a real life report, and you can see here that this particular product is well priced, very well priced. It's among best available rates and terms. So if this was in force, this would be a keeper. If this was proposed, this would be something that would be certainly worth considering, at least based on costs. And not to say that costs would, and that's not saying that costs are the only consideration, but based on cost, this would be worth considering. Benchmarking also reveals when costs are excessive and by how much. So again, this is a excerpt from a real life Veralytic report. This is a real life product available for sale today, or when this report was written or generated. And you can see how high costs are here. They're approaching worst available rates and terms. They are 17 cents per dollar of insurance, where we already established that best available rates and terms are closer to 10 cents per dollar of insurance. That means that if this were an in-force policy, that this client is overpaying by 7 cents per dollar of insurance. So for $1 million, so if you came across this client or this prospect, and this was $1 million policy, and you said, you know what you're being charged, and they said no, and you said, great, would you like to know? And they said yes, and you ran a Veralytic report for them, you could find for them $70,000 of present value money that they could use to either reduce premiums or make up for underfunding, or extend the coverage duration because where everybody's living longer, or reduce premiums, or increase death benefits, or reduce risk. There's lots of things you can do. This is what I call the flashlight, the ruler, and the bag of money business development strategy. You shine a bright light on the cost, you shine the flashlight on the costs, you get the Veralytic ruler out, you measure those costs, and when the costs are excessive like they are here, you put all that money in a bag, give it to the client, and say, how would you like to use this? For that matter, you could tell the client they could take it out of the policy and put it somewhere else if they wanted. Literally giving them $70,000. And at the risk of stating the obvious, if this was a $10 million policy, what would you be? What would you, the bag of money you'd be bringing to your client would be how big? Literally, and I kid you not, this situation happens. $700,000. So we've talked about cost competitiveness. Let's also talk a little bit about pricing stability, or the reliability of illustrated expectations. Ultimately, what the client earns is a function of their risk tolerance. If they're willing to be more, if their risk tolerance is more aggressive in nature, if they can take volatility over the short term, then they can benefit from that with higher returns historically over the long term. What are the, and then, so if that's the, if their tolerance is more aggressive, what are the asset classes that correlate with that risk tolerance? Or if they're more conservative, what are the asset class preferences for that risk profile? What's the time horizon? You know, if we only have 10 years, we don't have a full market cycle. We can't expect to get paid for the risk of paid for taking additional risk. And what are the expected outcomes from that, which is important to know what the expected outcome is, because the illustration is going to have a built-in expected outcome, and we need to correlate that. For instance, if we look at, you know, I've got risk profile, traditional modern portfolio risk profile on the left-hand side. Universal life and whole life policies are required by regulation. In fact, indexed policies are required by regulation to invest in high-grade bonds and government-backed mortgages. And yet we saw earlier that the product had to deliver a 14% rate of return using some strategy other than high-grade bonds and government-backed mortgages, but it's a different asset class. It's a different risk profile conversation. And so you've got to know what the expected outcome is from your strategy with the client, and then you've got to understand what the expected or the required performance is from the insurance product, regardless of the product type. You can do this by hand, but the way Veralytic does it very simply is it includes in every report the declared crediting rate, the rate of return prominently displayed above the calculations of non-guaranteed values. But then it also calculates in those detailed expense pages, it calculates the bonus rate or the under-disclosed or undisclosed in some cases, additional return that's required to meet client expectations. And then when you add it together, that's where you really figure out what the product risk is, so that you can then correlate that with the client's risk tolerance. If the client is not somebody who would be willing to invest in a mutual fund or a hedge fund that had a risk of loss corresponding to a long-term 14% rate of return, then you certainly don't want to put that client into a life insurance product that requires that. And you obviously have to know that, so you've got to dig deeper than what the NAIC illustrations model regulation gives you. So under CFP practice standards, at least by my view, illustrations are not inconsistent with the CFP practice standards duty to exercise skill, prudence, and diligence, whereas benchmarking, I would argue, is faster. We saw in that cost breakdown graph, at a glance, you can tell whether or not costs are excessive or competitive relative to the entire universe of peer group alternatives. It's easy. These illustrations, I commonly hear, particularly from RIAs, these illustrations are impossible to understand. Well, this is using benchmarking. It just takes simple math. You can subtract 10 cents per dollar of insurance for best bill rates and terms from 17 cents per dollar of insurance for the product under evaluation, and you know what the cost savings are. It's reliable. In our case, Veralytic reports have been FINRA reviewed for compliance with their rules, which I referenced earlier. Benchmarking is clearly more well established and common and proven in the fiduciary world, in the advice world, than is comparing these non-guaranteed illustrations. And as we talked about when we were talking about the New York best interest rule, they are absolutely consistent with at least the New York Department of Financial Services understanding and regulations on what is actually in the client's best interest, which again are very consistent with the CFP practice standards.